Hello and welcome to Money Control. Well, Donald Trump has assumed office as the 47th President of the United States. No big surprises or shocks on day one. Global markets are a bit mixed. Dollar fell last night but recovered some. US bond yields have also cooled off. Indian markets are sulking a bit today, but we are going to talk about slightly long term and how to navigate 2025, what will be the key drivers for Indian equities in 2025 with our special guest today, Nilesh Shah, MD of Kotak Mutual Fund. Thank you so much, Nilesh, for joining me on this discussion today.
Thank you, Mahalakshmi, for having me over here.
So I see you wearing a tikka. So what is this in aid of? Are you praying after Trump assuming office? Do we need prayers?
So this is just after our opening ceremony in Hyderabad. We opened office over here, moving from smaller branch to bigger branch, and that's why the tikka. I don't think so. We need prayers for Donald Trump. We need engagement with Donald Trump. And we can actually share how to create win-win situation between US and India. For example, when they buy anything from China, they are always worried about debugging and bugs and cybersecurity and other risks. Indians would have written billions of programming for American companies, but they don't have to worry about any bugs, any virus, any cyber warfare. Our programs have made American companies efficient, reduced cost for them, and also created jobs and opportunities for India. That's how we create a win-win situation rather than lose-win for America.
Right. And what do you expect as an outcome of this? Because there are so many contradictions in this, so-called Trump trade and the policies, the way he is laying it out. How do you see this play out in the markets?
So one, markets will be wary of President Trump's announcement. We all remember in his previous term, you used to go to Trump's handle on Twitter in those days and try to figure out what has he tweeted. But I think on a longer term basis, we'll have to see what actions are taken rather than what announcements are made. Many a times, like any other politician, you walk left and talk right. Your announcements will be to please certain vote bank, certain constituency, but your actions could be different. For example, everyone was thinking that President Trump will levy tariff on Chinese goods on day one. But as is evident, it will be on a calibrated manner, on a gradual basis. So we'll have to focus far more on action than on announcements.
And how do you see the dollar moving forward? Because that's one of the key concerns, at least from a market point of view, this whole rise of the dollar that has happened and money moving out of emerging markets. That seems to be a big concern, at least from a market point of view. How do you see that play out?
So as of today, US is like a vacuum cleaner which is sucking liquidity from all other parts of the world. As American interest rate goes up, undoubtedly people prefer to invest in US. After 100 basis point rate cut by US Fed, that 10-year treasury yield has moved up by 100 basis point. And today, 20% of American market believes Fed's next move will be rate hike and not a rate cut as 80% expects. In a scenario where US yields are giving 5% plus return, undoubtedly it will keep on sucking liquidity from rest of the world. But do remember that US dollar is nearly all-time high. It has appreciated against all major currencies. And President Trump, if it wants to make American manufacturing competitive, will prefer slightly weaker dollar rather than stronger dollar. So there is an interesting paradox going on where higher interest rates are taking liquidity from rest of the world, and American establishment might prefer weaker dollar to support manufacturing and exports.
That's correct. And so what do you see as the trajectory for the rupee? Because that's again a very key concern. It's partly a fallout of the dollar, partly also driven by domestic factors, and that will be a key variable to watch to see how the foreign investors navigate India.
While market is focused on rupee US dollar, we probably need to focus on rupee Chinese renminbi. Undoubtedly, our largest trade partner is China, and our competition in many markets is China. Now, if rupee keeps on appreciating against Chinese renminbi, it will be disastrous for our trade balance, our trade deficit. My feeling is that rupee has appreciated against all other major currencies except dollar, and it has moved in tandem with renminbi. Normally, when rupee depreciates, there is worry on Indian inflation, but this time that worry will be much measured because we have appreciated against other currencies. And we need to keep in mind Chinese renminbi. Any depreciation over there to tackle tariff undoubtedly will put pressure on our trade balance, and we may have to depreciate rupee in relationship with Chinese renminbi also.
Sure. And what is your prognosis for foreign investor? What do you see? How do you see the action around foreign flows in India, Nilesh? Because you said that in an era of higher interest rates, money will continue to move back to the US, which has been the trend. But last 1 or 2 months, we've been saying that maybe we've seen maximum flows go back already. We might be, at least the selling could stop, if not buying coming back. But it just doesn't seem to be stopping at all.
So one, if we see this year, it's not only foreign portfolio investors who have sold, but also foreign direct investor in some sense who have sold. For example, Hyundai doing their IPO, LG Electronics planning an IPO. We have also seen massive exits by private equity venture capital funds. So it's a combination of FPI plus FTI, which is redeeming from Indian market. Number two, foreigners have become underweight India against about 19% weight in MSCI Emerging Market Index. FPI's ownership is probably a little below 17%. Third, our markets had run up valuation wise. We were on a price to earning basis higher than most of our peer groups. We traded at average valuation premium, which was higher than our own historical average. Probably all those things resulted into some amount of profit booking. Going forward, if our earnings growth remain better than our peers, our return on equity remains better than our peers, and our governance standards are good, then certainly foreigners would think before selling because they are already underweight India. So my feeling is that foreigners will continue to behave in an erratic manner. Since 2020, we have seen them selling in few months, buying in some other months, and using India as a revolving door. My feeling is that that trend should continue. 2 months they'll be seller, 1 month they will be buyer.
So we've already seen more than a 15% correction in the market from peak levels, Nilesh. Do you see valuations as being attractive right now, considering the fact that earnings is also slowing down?
So, Mahalakshmi, you have hit the nail. If earnings had grown, then certainly valuations would have become cheaper. But unfortunately for us, September 24 as well as December 24 quarterly earnings have slowed down. Results have come below expectation. And that has ensured that valuations still remain reasonable. Despite 50% correction due to deferment of earnings, valuations haven't corrected by 15%. Our valuations are reasonable. Undoubtedly, there are still some stocks where valuations are expensive. The low floating stock counter, especially in PSUs, some of the micro caps and mini caps where float is controlled, their valuations are on the higher side. But if you look at other sectors, right from IT, pharma, private banks, cement, their valuation still looks reasonable. There are very few sectors where valuations are cheap. We are fairly priced market, not a cheap market.
Fair enough. And how do you see this? Of course, there has been a correction, but in the next few months, suppose we see flatlining of the markets, how do you see domestic flows reacting to that? Do you think so far we haven't seen any significant change in terms of investor behavior? At least domestic mutual fund flows have been quite strong. Do you see that being a little iffy if we were to see flat markets for the next few months?
So as of today, we believe many people are sitting on cash as they have changed their asset allocation in favor of non-equity products, looking at the valuation. Some of the smart people did book profit even in small and mid caps. So there is a cash waiting on the sideline to be invested. Second, mutual fund distributors and advisors have played a stellar role in hand-holding customers, and many of them have recency bias, especially during COVID time and during Russia-Ukraine war time, where despite correction in market, investing at every level made eminent sense for them. So based on that experience and the hand-holding by mutual fund distributors, we believe undoubtedly if markets continue to correct and return starts coming down, there will be some amount of slowdown in flows, but it will not be material. And do remember, there is a cash waiting to be invested. Now, whether it catches a falling knife or whether it starts getting invested when the markets have made a U-turn, that we don't know.
Right, right. And in your estimate, what kind of correction will make India a fairly valued market? Like today, do you expect it to be, considering the earnings trajectory for the next 12 months, another 10%, 20%? What would make it fair value for you and what would make it attractive for you?
So one is theoretical fair value. Based on historical averages, anything below 16p becomes cheaper. But then the range goes as low as 10p, as seen during 2008 subprime crisis and 2020 COVID crisis. But Mahalakshmi, please remember, there's no friend in the market. If I know a seller is aggressive and desperate, I will bring down prices way below fair value to give them an exit. Today, the selling by FPIs is restricted in terms of price. It's quantity, but at a price, not at any price. But we did see during COVID time, they sold even smaller quantity at throwaway prices. So it will be fair to say if the sellers are aggressive, there will be correction in market. As the aggressive selling stops, markets will stabilize. And the day seller turns buyer, markets will sharply rise.
Right, right. And Nilesh, what do you expect in this budget? I mean, is there anything that you would expect the finance minister to do to effect a faster recovery? I'm talking about earnings recovery. Of course, economic growth is also slowing, but what do you expect?
So undoubtedly, there are higher expectations from the budget, especially as September 24 and December 24 quarterly GDP growth is subdued. The first expectation is that you continue on the path of fiscal prudence. Honorable Finance Minister has committed 4.5% fiscal deficit for FY26 that need to be honored. Number two, there is subduedness in consumption, especially urban consumption. Some amount of tax concession, some amount of EMI subvention is needed to support urban consumption. Third, private capex remains subdued. There are multiple reasons for it, and hence the load of capex has to be taken by the government. This year, it's unlikely that we will be able to meet the budgeted target of 11,111 crore. Like last year, there might be a little bit of shortfall. But notwithstanding that, next year we should target higher capex as it will act as a harbinger or catalyst for private capex. Now, these are all conflicting objectives. You want to give tax cuts or subventions, you want to spend money on capex, and yet you have to ensure that fiscal prudence is maintained. This Triveni Sangam is difficult, and which is where Honorable Finance Minister will have to think out of box. The divestment receipts have remained way below their potential. Probably this is the year where we could increase divestment amount. Second, there is a fair amount of Indian savings which is tied up in unaccounted gold lying in tijoris and safe deposit locker. The gold holding of Indians is something which no one knows, but the estimates ranges from 2 trillion to much higher number. But a large part of this is in parallel economy. It's time that we mobilize that frozen savings and let that savings flow in Indian economy for the benefit of investments and growth. The third thing which finance minister can consider is exit tax. We have seen many Indians changing their residency and moving to Singapore, Dubai, and other countries. In US, if you renounce your citizenship and move out, you have to pay exit tax. Why can't we levy that exit tax on people which are leaving India? It will help raise one form of revenue. So between divestment, exit tax, and monetization of unaccounted gold, we should be able to raise enough revenue through which we can make investments, which whereby we can support urban consumption and yet maintain path of fiscal prudence.
Understood. Good points, Nilesh. One more question on the budget. How do you expect, what is your expectation on core capex? Because last year it seemed like a bit of a disappointment that capex overall number went up, but the core capex was substantially lower, I think just about 5% higher. Do you expect that to change? Nilesh, are you with me? So
Yes,
I was
now I'm with
asking, one disappointment with last budget was the fact that the core capex did not go up too much. It just went up, I think, 4 or 5%. The overall capex number was better, but core capex number was growth was not as good. Do you see that change in this budget?
So, as I mentioned earlier, we should raise revenue through out of box thinking and spend money on real investments. For example, today the world is moving way ahead on technology. Uh, while we are good on digital public infrastructure, are we making enough investments for new technology and artificial intelligence? As of today, the foundation program of artificial intelligence is all foreign owned. Between US and China, they have the AI's foundation program. Now, there are pros and cons of having our own foundation, but at least we should provide capital so that that kind of investments can be made. If you are using someone else's road, you will always end up paying toll. If it's your own road, you will always end up collecting the toll if there is a traffic. So we need to raise resources to make investments for future technology. When industrial revolution happened, it bypassed India. And for 200 years, our growth became zero. We cannot make that mistake during this artificial intelligence revolution.
Right. Okay. From a market perspective, Nilesh, of course, there are multiple factors at all times that impact markets and stock prices. Right now, there is the Trump trade, there is budget, there is the earnings. All of it is sort of conspiring to keep markets down. It doesn't seem like this time there is any pre-budget rally. So what will surprise markets and what will disappoint them?
So any deviation from fiscal prudence undoubtedly will surprise the market on the negative side. But some of the steps which can change India's growth orbit by supporting urban consumption, by supporting government's capital expenditure, will undoubtedly surprise market on the positive side. My recommendation will be please make a budget which supports economy and growth, which unleashes India's potential. Market anyway will be happy with those measures.
Right. And do you expect the any tinkering of the capital gains tax? Because last budget, everybody was concerned that 12.5% was a very odd number, and invariably it will become 15% and eventually 20% at some stage. Do you expect that to happen?
I think it is important that we provide stability in our policies. There are enough loopholes which are exploited by various people. Uh, there is unequal distribution of tax burden or tax compliance. A salaried employee pays much higher share of tax compared to a businessman. So instead of extracting more taxes from the people who are already in the tax net, the entire energy and focus should shift to people who are outside of tax net. There are more number of people who are buying expensive cars, then correspondingly declare income. So instead of focusing upon people who are already in tax net, let's increase tax revenue by focusing on people who are out of tax net.
Fair enough. And tell me about your assessment of earnings growth. This year, most analysts are not expecting more than 5%. We will probably close fiscal 25 with 5% earnings growth. Next year, do you see it going to about 12%? And what will that be contingent on?
So clearly, this year the base had become big. We almost crossed, we are expected to cross about 1,050 Nifty EPS this year, which will be about 5 to 6% growth. Next year's expectation to begin with was at 1,250. Then it came down to 1,200, and now it looks like we'll be somewhere around 1,150, 1,175. The large driver for earnings growth are sectors like oil and gas, financial services. Now, for financial services, cost of deposit needs to come down. And for that, liquidity has to improve. For oil and gas kind of sector, oil prices should remain subdued. Our feeling is that with yesterday's announcement of President Trump on drill, baby, drill, oil prices will remain subdued. That should be beneficial to the oil and gas sector. Liquidity, RBI has been doing repo reverse in market. So hopefully liquidity should improve, which will lower cost of deposit for the banking system. So there is a reasonably good chance for earnings growth to come in double digit. Now, whether it's 10% or 12% or 15%, a lot will depend upon how things shape up.
Understood. And if you were to just map the markets, tell us some pockets that you think are overvalued and some which look like reasonably good hunting grounds for people who want to buy right now.
So undoubtedly, it is a bottom-up story. First of all, people will have to moderate their return expectation. Despite recent correction, last 5 years return for broad market was about 17-18%. Small and mid cap delivered about 26-27% return. But before that, for 15 years, the broad market return was 11%. Small cap delivered just 7.5% return. So most importantly, before investing, we'll have to reconcile that going forward, returns will moderate significantly. There will be higher volatility because of variety of geopolitical events, even in that moderated return. With those two caveats, moderate return expectation and be ready for higher volatility, we think it's time to go for quality over momentum. It's time to go for high floating stocks over low floating stock, controlled floating stock counters. And it's time to look at valuation far more carefully. IT, pharma, private banks, cement, some of the rural focused consumer staple companies look reasonable from a valuation point of view. Some of the companies on micro caps, mini caps, low floating stock PSUs, some of the capital goods company look very, very expensive from a valuation point of view. There is a churn going on in the market where some of the momentum stocks have corrected far more than the market, and some of the quality stocks have not corrected as much. We think this cycle will complete a full circle, and which is why quality over momentum high floating stock over low floating stock, and reasonable valuation over expensive valuation.
Right. Thank you so much, Nilesh. That's all we have time for this morning. Thank you so much for joining us.
Thank you.
That's all on the show today. Thank you so much. Hope you enjoyed watching this this interview and got some idea of how to navigate 2025. Thank you so much.